Okay, so what if I told you something? That this huge explosion in AI, the tech that's really reshaping our entire world, what if it's not just like some distant cousin to Bitcoin,
Hmm.
but maybe its closest ally? Or perhaps even its fiercest competitor for, well, for the very same resources.
Yeah.
It's a pretty wild thought, isn't it? Welcome to the deep dive. Today, we're pulling back the curtain on a connection that honestly is often overlooked, but is actually fundamentally profound. We're talking about the intertwined destinies of artificial intelligence and Bitcoin.
Yeah.
We're going to explore how AI's incredible, really rapid growth isn't just happening alongside Bitcoin. It's deeply mathematically shaping its core mechanics, its security, even its long-term value. You might think they're in totally different worlds, but well, you're about to see how they're kind of locked in this silent, high-stakes dance.
That's exactly right. And for our deep dive today, we're really leaning on this pretty comprehensive analysis. It looks at what some call the global bet on AI and digs into the specific mathematical implications this focus has for Bitcoin. It's data-driven. We're trying to get past the speculation here.
Exactly. And our mission for you, our listener, is pretty clear. We
Yeah.
want to give you a sharp, kind of actionable vision of this relationship. It's symbiotic, sure, but also often competitive. We'll look at the immediate pressures, the short-term stuff, but also the really big long-term implications. The goal is you walk away genuinely understanding what's going on with something that's quietly but powerfully shaping our digital future. Okay, let's unpack this. Because honestly, the deeper you dig, the more you realize these two aren't just coexisting. They're kind of fighting over the same fundamental stuff. So at the very heart of it, this unexpected link, it's really about a shared, almost insatiable thirst for power, computational power.
Mm-hmm.
Think about it. Advanced AI, right? Training these huge language models, run incredibly complex neural networks. It needs massive computational muscle.
Yeah, huge amounts.
And then you've got Bitcoin mining. Proof of work. It also needs an enormous amount of processing power. They both rely on the exact same fundamental thing: intense, specialized computer hardware. It's basically a global race for silicon.
That's it, precisely. And this race, it plays out on a very specific hardware battleground. We're mostly talking about GPUs, graphic processing units, and ASICs, those application-specific integrated circuits.
Okay.
What's really striking is the demand for the absolute top-tier high-end chips, like NVIDIA's H100s, A100s. It's overwhelmingly driven by AI right now.
Right, you hear about that all the time.
But those exact same chips, or maybe their slightly older siblings, are also incredibly desirable for Bitcoin miners.
Ah, okay, so direct competition.
Direct and often fierce competition. And that inevitably drives up the prices for these critical components,
Which means?
which in turn directly pushes up the cost of Bitcoin mining. It just gets more expensive to secure the network.
Okay, so this intense hardware competition, the rising costs,
Right.
it feeds directly into Bitcoin's engine, right?
Yeah.
Hash rate, which, as we know, that's the measure of the network's total computing power. And we've seen just incredible exponential growth there over the years. It kind of defies early predictions.
It really does.
And this isn't random, is it? It connects to that idea, Metcalfe's law.
Right. Metcalfe's law. The idea that a network's value is sort of proportional to the square of its users or participants,
So more users,
Yeah.
exponentially more value or potential value.
or in this case, more compute power joining the network. It means the potential interactions, the security, the overall value proposition can grow dramatically.
So given this rising cost to participate and this strengthening network, what does that ultimately signal for Bitcoin's fundamental value and its security in the long run? How does that loop work?
Well, it's a really fascinating dynamic. It points to this self-reinforcing cycle. A higher hash rate, which is being boosted by both AI demand and dedicated mining.
Mm-hmm.
It doesn't just make Bitcoin more secure, like harder to attack. It also acts like a magnet. It draws in more miners, more investment, more innovation, creating that powerful positive feedback loop you mentioned. So yeah, it suggests a continually strengthening network, but importantly, one whose value is increasingly tied to real-world investment. We're talking cutting-edge hardware, massive energy infrastructure.
Right.
It's not just digital. Its security is rooted in physical, tangible capital.
That feels like a really crucial distinction. It's not just abstract code. It suggests a real tangible value proposition. It kind of anchors Bitcoin in a way to the real economy of compute and energy.
Exactly.
But how does Bitcoin keep its schedule, that steady 10-minute block time, when there's this constant increasing wave of computing power hitting it? There has to be some kind of governor on the engine.
Absolutely. And that's where Bitcoin's genius really shines through, I think. It's the difficulty adjustment.
Okay.
Bitcoin has this built-in mathematical dial, you could say, called difficulty. And it's critical because it automatically adjusts itself every 2016 blocks.
Which is about 2 weeks, roughly.
Roughly every 2 weeks, yeah. And its only job is to keep that average block generation time right around 10 minutes. It's quite elegant, really. Shows the network's resilience.
And the math isn't like impossibly complex conceptually, right? It acts like that cruise control you mentioned. Can you walk us through that a bit? How does it actually adjust?
Sure. You can picture it pretty simply. The new difficulty setting, let's call it D new.
Okay.
It's calculated by taking the previous difficulty, D previous, and multiplying it by a ratio. And that ratio is the target time for those 2016 blocks. So 2016 times 10 minutes.
Right, 21, 60 minutes, the ideal time.
Divided by the actual real time it took the network to mine those last 2016 blocks.
Ah, okay. So if they came in faster than expected.
Exactly. If the real time was less than the target, the network automatically increases the difficulty. Makes it harder to find the next block, slows things down.
And if it was too slow?
Then the difficulty decreases. It speeds things up. It's this constant autonomous recalibration. Like you said, cruise control, keeping a steady speed, whether you're going uphill or downhill.
So, okay, connect the dots for us. We see this massive AI-driven surge in global computing power that immediately shortens the real time in that equation. Right?
So blocks get solved faster.
And the network just responds by making it harder.
Automatically.
And the key thing here, for you listening, is that this isn't just some techie detail. It has huge economic consequences.
Huge. This constant upward pressure on difficulty, driven by this overall growth in compute power from both AI and mining, it directly hits miner profitability. It's like an economic pressure cooker.
How so?
Well, higher difficulty means miners need more computing power or more efficient hardware just to mine the same amount of Bitcoin. It's not a static goal. The goalposts are always moving.
Right.
And this relentless pressure forces them to constantly invest in the absolute latest, most energy-efficient hardware. And, critically, always be hunting for the cheapest, most reliable energy sources they can find.
So it drives innovation.
Absolutely.
Yeah.
A powerful cycle of technological innovation within the mining sector itself.
And mathematically speaking, what's happening is the marginal cost, the cost to produce one more Bitcoin is always tending to increase.
That's the core economic effect, yes.
And if we zoom out, connect that to the bigger picture, this rising marginal cost could theoretically act as a kind of floor for Bitcoin's price in the long run.
It's a compelling argument.
It's often overlooked, I think, but it suggests Bitcoin's underlying value is genuinely tied to real-world resources, energy, silicon, innovation.
Yeah.
So for you, the listener, this implies Bitcoin isn't just, digital ether. Its value gets increasingly tethered to tangible production costs. It makes it a pretty unique asset class.
Okay, but this brings us to the other elephant in the room, a big one, energy.
Oh, yeah.
Both AI training, these massive models, and Bitcoin mining. They are notoriously energy hungry.
Absolutely.
We're hearing that AI's electricity consumption is rapidly becoming comparable to what Bitcoin mining uses globally. So you've got this kind of alarming double demand scenario hitting the grid. It's a huge challenge, no doubt. This dual demand really does increase the risk of, overtaxing electrical grids, especially in places maybe without robust infrastructure.
Right.
And it just intensifies the competition for energy resources everywhere. It's a race not just for chips anymore, but for the actual electrons.
So the big question becomes, where do we get all this power? How do we supply it?
It does. And what's interesting, maybe even counterintuitive given some narratives, is the renewable connection. The raw economic need for cheap and constant power has actually pushed a lot of Bitcoin miners towards renewables.
How so?
We see large operations setting up near untapped hydroelectric power or building next to big solar farms, using wind energy in remote spots, basically finding stranded or cheap renewable energy.
So it kind of aligns mining with sustainability goals, almost accidentally, creating a market for that green energy.
In a way, yes. Which might surprise some people. It creates a buyer for surplus renewable energy that might otherwise be curtailed.
But there's always a but.
There is. The surging, almost exponential demand for power from AI could potentially siphon off those same renewable resources. Or at the very least drive up the price significantly for everyone.
So it hits miner profitability again, a new pressure point.
Potentially, yes. It's this delicate balance. Both AI and Bitcoin are driving investment in renewables, which is good.
Right.
But they're also competing fiercely for that output. It could make it harder for either to scale sustainably without just building vastly more energy infrastructure overall.
Wow. It really puts it in perspective, doesn't it? These two tech giants literally competing for the same raw power. So, okay, looking ahead, what's next in this symphony of silicon and scarcity? It feels like AI is set to play this really dual role in the Bitcoin world.
It seems that way.
First, maybe AI optimizing mining itself, like going beyond just faster hashing. Could AI make mining smarter, maybe? Predict optimal times, improve efficiency somehow?
Oh, absolutely. That's a very real possibility. Applying AI to the mining process. Imagine AI algorithms analyzing, real-time network conditions, fluctuating energy prices, maybe even weather forecasts that impact renewable output.
To predict the most profitable strategy.
Exactly. To optimize mining strategies on the fly. This isn't really science fiction. It's an evolution towards more intelligent, adaptive mining. Maybe even helping manage heat better, predicting hardware failures,
Okay.
even optimizing the firmware on the chips for tiny gains.
Yeah.
It would be a big leap in how sophisticated these operations are.
That's a fascinating picture of efficiency. But let's flip to the other side, the financial markets.
Okay.
We know AI trading bots are already active in crypto, but as AI gets really advanced with serious predictive power,
Right.
how could that change Bitcoin's volatility? What happens when trades are driven purely by ultra-fast analysis, not human gut feelings?
Yeah, that's where it gets really intriguing
Yeah.
and maybe a bit concerning too.
How so?
Well, on one hand, more advanced AI could lead to much more efficient markets.
Right.
Price discovery could become incredibly fast, maybe squeezing out some of the purely emotion-driven
Yeah.
bubbles,
More rational.
potentially.
Yeah.
But that efficiency could also introduce new kinds of systemic risk, volatility that's essentially controlled by machines.
Meaning?
Now imagine multiple super sophisticated AIs all interacting, optimizing for profit. They could potentially create these incredibly rapid cascading effects based on their programmed logic, faster than humans could even react.
That's a sobering thought. Could that efficiency actually backfire, create instability, like flash crashes or weird feedback loops that maybe humans, with our, intuition or caution, might avoid?
It's possible.
What happens when human judgment is just completely outpaced in such a critical market? It's more than just faster trading. It feels like a fundamental shift.
It is, and it's a deeply important question. While AI might smooth out emotional swings, the sheer speed and interconnectedness of these algorithms could also amplify movements.
Yeah.
A tiny error, an unexpected piece of data. It could trigger a cascade of automated responses. You could see unprecedented volatility or weird market dislocations before humans can even figure out what's happening.
The complexity itself becomes a risk.
Exactly. Predicting the collective behavior of these complex systems, especially under stress, that becomes incredibly difficult.
Wow. Well, this has been quite the journey, hasn't it? Really exploring these deep, often hidden connections between AI and Bitcoin.
It really has.
We've seen they aren't just separate things running in parallel. Their growth creates this fundamental mirror dynamic. AI's hunger for compute directly bumps up Bitcoin's difficulty, its mining costs.
And maybe counterintuitively, our sources suggest that AI's success doesn't necessarily hurt Bitcoin. It acts more like a catalyst for strengthening it.
How so?
It pushes the Bitcoin network towards greater efficiency, better security, forces that relentless drive for resilience we talked about. That constant pressure actually makes the network tougher, more robust over time.
But it's not all smooth sailing. This convergence definitely brings major challenges we need to keep an eye on, right? We've got the massive growing energy demand. That whole sustainability question needs answers.
Yep.
There's the potential risk of centralizing computing power if only a few companies control the best chips. That could challenge Bitcoin's whole decentralized idea.
A definite risk.
We just talked about the new kinds of market volatility from AI trading. And of course, for the miners themselves, it's just this relentless, never-ending race for innovation just to stay in the game.
Absolutely. So maybe the final thought to leave everyone with is this. As AI keeps marching on, getting more and more tangled up with our digital financial infrastructure, consider this. What role is left for human oversight, for ethical frameworks, for our ability to see the big picture, especially when the security and value of something like Bitcoin are increasingly shaped by cold, hard, calculating AI logic?
Yeah.
How do we get ready for a future where machines aren't just driving efficiency, but maybe dictating parts of our financial destiny?
A profound question indeed. Thank you for joining us on this deep dive. Until next time, keep digging, keep learning, and definitely keep questioning.